Hey everyone, today is Thursday, March 28th. It is the last day of the quarter. The markets and our offices are closed tomorrow for the Good Friday and Easter holiday weekend. So we wrap up Q1 today with the S&P 500 up 10%. The NASDAQ year to date is up a little under at 9%, having corrected the last couple of days. And bond index is down a little over 1% at negative 1.26. Today we're going to talk about three things. We're going to talk about short-term interest rates and Fed policy and how we see it playing out over the rest of the year. We're going to talk about the current market levels and how they compare to our year-end outlook. And lastly, we're going to talk about how we're playing the current environment with stocks at this elevated level. And we're going to talk a little bit, I've been asked quite a bit, do we think we're entering a bubble? So we'll address that issue. So getting on with topic number one, short-term interest rates. As we entered 2024, Wall Street consensus was they expected 6, maybe even 7 interest rate hikes by the Federal Reserve over the course of the year, starting as early as March. March has come and gone. We were pretty early on saying we didn't expect any more than 2, maybe 3 cuts as the year developed. So the street has now come our way on interest rates. We're sticking by what we say. We just don't see, because the back end of the yield curve, right, 5-year, 10-year, and 30-year bonds have come down into the low 4s, up as high as almost 5% a few months ago. You know, we're more comfortable that the Fed has gotten some slack here, that they don't need to rush to cut rates. They do need to uninvert the yield curve, so we do expect them still to cut, but a couple of rates, and maybe 4 over the course of the next year or year and a half. But we'll wait until later in the year to determine that. So current market levels versus our year-end targets. Currently, the market is trading at 5,252 on the S&P 500. That is at the upper end of our year-end target. We set a target at the beginning of the year at 5150 to 5250. After we were at 5100, we elevated a little bit in February, given some things we were seeing in the strength of the markets. So now the market's at our year-end and that is trading, if Wall Street consensus for the years for the S&P 500 companies to earn $240 a share, that takes us to a multiple of 21.9 times earnings. So that's getting a bit on the frothy side. And so what we see is one of 3 things is going on. Either the market's getting a bit frothy and trading up in here, and it doesn't really make sense with the valuations. It means that Wall Street has underestimated the strength of the economy and corporate earnings for the year. Or it means we're going to get a nice correction in here and it'll reprice everything back into our range, and earnings won't increase. There is something going on that the market could be pricing in, which we'll talk about at the end of the video, but it has to do with the global central banks around the world. What is good on this market is that the market is now starting to broaden out. You saw all the high tech, the large cap tech companies really flying at the first couple of months of the year, and then the last week or so, they've all pulled back. And you're seeing really big, diversified companies, Berkshire Hathaway, JP Morgan, Eli Lilly, and many other companies hitting new all-time highs. And they had, in the last 6 months, really been left behind by big cap tech. So that's a really positive thing in here. But again, we think the market's a little ahead of itself, or something's going on that we don't see, which is why we're not really going to de-risk, which it's going to take me to our third bullet point that we're going to talk about today, which is how we're playing the current market environment and what investors should be doing now. So with the street coming around to our 2-rate outlook, and yesterday, Fed Governor Chris Waller came out and said he doesn't see any reason for the Fed to go more than 2 hikes, maybe 3. So that has all come to what we were thinking might happen at the beginning of the year. And again, we think the first cut is probably going to be in June or July. But then you're going to have the election coming up, so they're going to go quiet in front of the election, and then we'll probably see another one in late November or December. And again, how we're playing it. Look, this is a tough point in here because we keep hitting highs. The market is getting frothy. Clients are asking us, are we taking money off the table? Are we taking some profits? Are we raising some cash? And the answer is no, we're not. We're sitting tight with where we are. We always have cash coming in from our clients, especially this time of year, at the beginning of the year, from bonuses, et cetera. Our tricky part is what do we do with that money, or a new client comes on board. We've gotten a few this year that, we have to work large amounts of cash into the market in a very elevated environment. So, we're kind of sitting on our hands right now. If we kind of view we can't lose this way, if the market keeps trading up, we're just, as we always say, we're just going to ride what we have higher. And that would be a great thing to happen, although we're getting a little frothy up here. But investors should be ready and comfortable with the prospect of a 5 to 10% correction happening between now and say into the election. It could come at any point. It could come fast. It's going to feel like the market is losing its confidence. The stock market's going to feel like it wants to keep going down until one day it's just going to stop going down. It's going to start trading up again because of our 5250 year in value based on what corporations are going to earn. So we'll see. And then there's always some news that could come up that can stop the rally in the market too. But you can never forecast that. So so how we're currently playing it, we're sitting tight in here. We're not chasing this thing at higher levels. We're sitting on some cash that we're going to buy it with, but we're not taking profits either. Look, you need to handle this market as a long-term investor, not a trader, and not a short-term focused person who's going to get scared of the market. We're investors. We've had stocks get collapsed in half and still ride with them to new all-time highs. If you sell out of them, you've given yourself a couple of tricky decisions. First is when do you get back in, and then what do you buy? And really, you're better off just sitting tight in the great companies that you own or the index that you own and riding it from there. Are we in a bubble? I've had several clients in the last couple of weeks ask me if I thought we were in a bubble. My short answer is no. I don't think we're anywhere near a bubble right now. Even with some of the rapid rise in some of these tech companies we own, you've got to remember, I was watching CNBC the other day, and a gentleman who's on frequently on an afternoon show said, I think we're in a bubble. And I immediately had to go to Wikipedia page for him and whatnot and look him up and see how old he was. And he was like 23 or 24 in the last real stock market bubble I've seen, which was 1999. So he'd been in his career maybe 2 or 3 years. At that point, I was in my career about 12 years. And we really experienced what a bubble feels like. This is nowhere near that for several reasons. One is all the tech companies there were prospect ideas. We weren't even using email that much in the 90s at all. Facebook wouldn't be around until 2008. And social media and the internet and constant connectivity. So these were all hyped up ideas. Today, you've got companies earning $20 billion or making $20 billion in revenue sales a quarter. Like, it's amazing what these corporate revenues and corporate earnings are. Real spending, generating real growth in global economies. So no, a company like Coca-Cola traded at 60 times in 1999, 60 times their earnings. Today, it's trading at 21 times their earnings, which is the market multiple. And they're going to be a little bit out. You can buy stocks, like bank stocks are trading around 12 times earnings, and they're still cheap. You've got to remember that, why does Coke trade elevated? Well, it does because those earnings are so reliable. Google, Microsoft, they trade at high valuations because people don't stop using their products. Their earnings are reliable, and in times of uncertainty, people are willing to pay more in terms of the stock price to earn those earnings in the future. So, yeah, short answer, no. I don't think we're anywhere near a bubble. That being said, don't be surprised if 5 to 10% correction shows up in the imminent future, maybe in the next few months. We're buyers on that weakness. We're sitting on the cash that has come in over the last 3 months, and we're going to be nibbling. And if we don't get that pullback, we're dollar cost averaging a little of the money each week. If we are buying a new stock or adding new stock to the portfolio, we're not taking cash, we're not selling bonds to buy more risk in the equity market. We're simply trimming other big holdings of ours that have done very well. And re-diversifying those into what we think are the new prospect ideas. We've got about 5 to 10 companies that we're nibbling on in here. And then the last thing that we've talked about, and maybe that's why this market is running up here. Maybe the market's catching wind of this, but we see sometime between now and the end of the year, we're going to see a global campaign to cut interest rates by global central banks around the world. We've already started seeing it in some of the emerging markets. Chile, Colombia, Mexico have cut rates. In developed markets, Switzerland cut rates last week. So this is just beginning to take hold, and you're going to hear more and more about it. Once the Fed goes, it'll be the green light for the ECB, the JCB, European Central Bank, Japanese Central Bank, and other central banks around the world start cutting rates. And that's going to be pretty exciting. That's going to price in the entire next wave of economic and earnings growth around the world for the next big run up in equity prices. So that could be exciting. Again, don't be surprised for 5 to 10% correction, and we'll cross that bridge when we get to it. So I hope everyone has a great long weekend, and we'll talk to you all in a couple of weeks. Bye.